Welcome to Financial Statistics. Today, we are diving into one of the most fascinating and powerful tools in modern finance, call and put options. If you have ever wondered how investors protect themselves from sudden market crashes or how airlines lock in fuel prices months in advance, you are in the right place. We are going to build your understanding of these financial derivatives from the ground up, starting with a simple everyday analogy.
To understand options, imagine you want to buy a house in 6 months, but you fear prices will skyrocket. You could pay the seller a small fee today for a contract guaranteeing a fixed purchase price. If the house value jumps, you use your contract and save a massive amount of money. But if the market crashes, you simply throw the contract away and buy at the new lower price. This simple idea, paying for the right but not the obligation to do something in the future, is the absolute foundation of financial derivatives.
Now that we have the intuition, let us define the formal terminology used in financial markets. The item you are buying or selling, like a share of stock, is called the underlying asset. The locked-in price written on your contract is the strike price, denoted by the letter K. The contract does not last forever. It has a maturity date when it expires. Finally, there are two main styles. European options, which can only be used exactly on the expiration date, and American options, which offer the flexibility to be used any time before they expire. With our terms defined, let us look at the first of the two main flavors of options, the call option. A call option gives you the right, but not the obligation, to buy a specific asset at the strike price. Think of it exactly like a discount coupon that locks in a maximum purchase price for something you might want to buy later. If the market price goes above your locked-in price, you use the coupon. If it stays below, you ignore it. It is a perfect shield against rising prices. So, how do we calculate exactly what this call option is worth when it expires? We look at the difference between the current market price and your locked-in price. This brings us to the call option payoff formula. C represents the payoff value. S is the spot price or the actual market price today. K is your strike price. The max function simply means we choose the larger of the two values. If the market price S is higher than K, you make a profit of S minus K. If S is lower, you walk away and the value is exactly zero. As the market price increases, your payoff increases. Let us see this formula in action with a concrete example. Suppose you buy a European call option on Apple stock. Your contract gives you the right to buy the stock at a strike price of $150. Today is the expiration date, so we need to evaluate the contract. You check the market and the actual spot price of Apple stock today is $170. We need to find out how much this option is worth right now. Continuing with our calculation, we bring in our standard call option payoff formula. We substitute our spot price of 170 and our strike price of 150. Subtracting 150 from 170 gives us a positive difference of 20. We then choose the maximum between 20 and 0, which is 20. This means your call option is worth exactly $20 at expiration. Physically, this makes sense. You have the right to buy a $170 stock for only $150, instantly saving you $20 per share. Now that we have mastered call options, let us imagine the exact opposite scenario. What if you already own an asset and are terrified the market will crash? This is where the put option comes in. A put option gives you the right, but not the obligation, to sell an asset at a specified strike price. It acts exactly like an insurance policy for your property. If the market crashes, your put option becomes incredibly valuable because it forces someone else to buy your asset at the higher locked-in price. Because a put option is the mirror image of a call, its mathematical value at expiration is also mirrored. Here is the put option payoff formula. P represents the payoff value. Notice that inside the max function, the order is reversed. It is K minus S.
You will only exercise this right to sell if the market spot price, S, drops below your guaranteed selling price, K. If the market price is higher than your strike price, you would rather sell on the open market, so you let the option expire with a value of 0. As the market price decreases, your put option value increases. Let us apply this put formula to a real-world scenario. Imagine you hold a European put option on Tesla stock. Your contract guarantees you the right to sell your shares at a strike price of $200. The expiration date has arrived, and unfortunately, the current market price of Tesla stock has dropped significantly to $160. We need to calculate the payoff of this put option to see if it will protect us from this price drop. Continuing our Tesla example, we start with the standard put option payoff formula. We plug in our strike price of 200 and our current spot price of 160. Subtracting 160 from 200 gives us a positive difference of 40. The maximum between 40 and 0 is 40. Your payoff is $40. You are effectively forcing someone to buy the stock from you for $200 when it is only worth 160 on the open market, netting you a $40 advantage per share. In both of our examples, the options ended up making a profit. Traders have a specific term for this: moneyness. Moneyness is simply a quick way of asking, if I were forced to use this option right this very second, would it make me money? If it yields a positive profit, it is in the money. If the strike price exactly equals the current market price, you break even, which is at the money. If using it would result in a loss, it is out of the money. Remember, an out-of-the-money option is not completely worthless if it hasn't expired yet, because the market could still move favorably. Because calls and puts are exact opposites, their moneyness conditions are also exact opposites. For a call option, which is the right to buy, you are in the money when the spot price is strictly greater than your strike price. You want prices to go up. For a put option, which is the right to sell, you are in the money when the spot price is strictly less than your strike price. You want prices to go down. Understanding these conditions helps investors instantly gauge how safe or risky their option contract is at any given moment. Let us visualize everything we have learned by looking at these payoff graphs. On the left, we have the call option. Notice how the blue line stays flat at 0 when the spot price is below the strike price K. But once the spot price crosses K, the payoff rises steadily at a 45-degree angle. Your profit potential is theoretically unlimited. On the right, the put option is the exact mirror image. The red line shows maximum payoff when the spot price is 0, and it slopes downward until it hits K, after which it stays flat at 0. These graphs perfectly illustrate how options provide a safety net. You might be wondering, why do call and put options matter so much in the real world? They are the ultimate tools for risk management. For example, airlines use call options on oil to lock in maximum fuel prices, ensuring that a sudden supply shortage does not bankrupt them. Conversely, farmers use put options on their crops to guarantee a minimum selling price, protecting their livelihood against sudden drops in agricultural markets. Without options, businesses would be entirely at the mercy of unpredictable price swings, making long-term planning nearly impossible. We have covered a lot of ground today. Let us review the key takeaways. Remember that options are simply contracts that give you choices rather than obligations. A call option is the right to buy, acting like a protective ceiling on your costs. A put option is the right to sell, acting like a protective floor under your assets. By understanding their mathematical payoffs and the concept of moneyness, you can now see exactly how these derivatives provide a vital financial safety net against the unpredictable nature of global markets. Great job mastering these foundational concepts.